Hey everybody, welcome to the Financial Thing live stream. It is Thursday. It's August the 1st. Can you believe it? August the 1st. My hair is doing crazy things today. I don't know what's going on. But I cannot believe it's already August the 1st. We're heading into the back part of the year. And as I found, the older I get, time seems to move along more quickly. Which is why we have to plan ahead. Talk about finances, blah, blah, blah. But I hope you're having a really good week. There's Harley in the background, having a good snooze. Looking a little pixelated today, I don't know why. That is the, of course, Harley cam sponsored by Cufflink. She is really a live dog. The official dog of the Financial Thing channel. Anyway, yeah, thanks for coming and spending an hour or less or more with me. Don't forget, this month we have both Narinda, CEO of Cufflink Live, and also Peter Reed from Assets Exchange is going to be here. I'll put the dates in the Facebook group. Of course, if you're signed up for the email list, you'll get an email reminder of when those guys will be coming on the stream live. Bit of a quiet week for peer-to-peer lending. Did get a couple of interesting questions in the mailbag. So, when the week's quiet for peer-to-peer, we just kind of look at other things that are going on in the financial world. Maybe things just in the world in general, but we will certainly talk about some peer-to-peer lending today. Quick word from our sponsor. Where are you? Why are you not coming up? Hang on a second. No, the sponsor thing is, hold on. Let me bring that up. Here we go. The wonders of technology. Cufflink, of course, is the Financial Thing live stream sponsor. You can get up to 10.25% gross per annum. They've got now over £350 million invested since 2016. Zero investors' losses to date. Of course, that's never a guarantee. Capital is at risk. Don't invest unless you're prepared to lose money. Please check rates on Cufflink's websites as rates do change. You can sign up and get a free account at join.cufflink.com/financial-thing. Thank you so much for Cufflink for sponsoring the stream. Get that 1 year rate locked in, 10.25%, because interest rates are starting to look like they are going to fall. We already had the Bank of England base rate cut of 5.25% down to 5%. I think that's probably going to be maybe one of a couple of different rate cuts this year that we see. Who knows for sure? But you can lock in a good rate right now. You may want to do that because I don't think rates are going to go back up again for a while. I think they will eventually, but not right now. So inflation is going to continue to be a problem. That is another conversation, but yeah, you can check them out. Thank you again to Cufflink. Please hit that thumbs up if you can. Subscribe to the channel. Tell your friends, family about the channel. Leave a comment down below, all that good stuff. Wow, that was fast. Let's get into a quick hi to everybody who's in the chat. Of course, it is a very balmy 94 degrees Fahrenheit, which is about, 34 degrees centigrade. It's hot here. I'm looking forward to getting into the cool weather. Hot summer. I know it's hot in the UK right now. You guys are not prepared for the heat. Yeah, the UK doesn't have air conditioning for the most part, so when it's hot, it kind of sucks over there. I know. I've been there. But you want warm weather, that's the price you got to pay. Hi to Colin in the Peak District. He said, finally sunny. Good. Peter Vince and Leatherhead has just had a brief thunderstorm where it's warm and humid. Dave Dawson in a very sunny Staffordshire. Stephen Hailing in Nottingham, and Mike Powell, wherever you are in the world. Welcome. Thanks for joining. If you're joining in the future, hi. Let's get right into the stuff for today. First is going to be, I'm Paul Bagworth in Kenilworth. Hi. First of all, we're going to look at an email that I got. It's a very, very broad email. It's one that I get quite often. Hi, Larry. I don't know. Larry, really? Come on. Larry. Is peer-to-peer lending still worth investing in? I see some bad things. but I know you've been in it for a while, so I wanted to hear your thoughts. Cheers, Barry. Well, from Larry to Barry. Hi, Annabelle from sunny Costa Blanca. So, it's a bit of a broad question. Is peer-to-peer lending still worth investing in? I would say that, in my humblest of opinions, if we look at what's going on in the financial world right now, we are seeing a lot of instability and a ton of volatility. No doubt you have been checking the stock market prices, and what are you seeing? Volatility, cryptocurrency, even in the big boys like Bitcoin, you're seeing the volatility. This is 7 days. Look at the volatility, right? 70,000 we almost hit, and now back to 62,000. In the stock market, we're seeing the volatility, not only in the UK. This is the FTSE 100, blue line at the top with the S&P 500. Notice, by the way, how much in sync these two lines really tend to follow each other. You can see the dip here in the FTSE and the dip in the S&P, and then the spikes here. Spike in the FTSE, spike in the S&P right up here. Dip down here in the S&P, dip in the FTSE. So for people that say that the UK market doesn't move like the US market, the charts really show that that's absolutely untrue, that the volatility does tend to match each other. But anyway, going back to peer-to-peer lending, since we're seeing so much volatility now in not only the stock market, cryptocurrency, and other investments, also gold, peer-to-peer lending might provide just that, one shining ray of stability without the volatility. Now, of course, you always have the implied risk of a peer-to-peer lending company going busto, because it does happen. We've seen it in the past. In fact, if we go back, these ones didn't necessarily go broke. Of course, we have had the ones that go broke. But remember RateSetter? Look at those rates, right, that they used to offer. This was a screenshot from the very, very early days of RateSetter that I pulled from the web. Look at these numbers up here. Lender money available, £214,000. Borrower request, £55,000. Money matched, £176,000. This was before RateSetter became the behemoth that it ended up being. So yes, Barry, I have been in peer-to-peer lending for a while. I remember these early days. I wasn't quite in this early, but I was in pretty early. We can see also these are the early Zopa days that I pulled offline. This is from back in 2005. And then Funding Circle. Not a very good screenshot, but nonetheless, this is a screenshot from the mid-2000s. And we kind of went through this volatility of what happened with peer-to-peer, and then, you know, we had the big three companies really close their shop to retail investing, for better or for worse. And then we had the implosions of obviously the other companies went into administration that you all know about. So we had some volatility there, but then what happened at the end of it when the FCA really clamped down on how these companies operate is we saw I believe some kind of now stability in the sector, where it's just kind of boring at the moment, right? Nothing's really happening. You've got companies that seem to be established well, loan pads, the Cufflinks, the Easy Monies, the blend networks, the prop lens, you know, they're out there. I don't need to go through all the list, but I think those companies have brought some kind of a stability to the market. And what you could do, Barry, if you're listening to this, is use peer-to-peer as a hedge against the volatility that I think we're going to really experience, especially this year in 2024 as a U.S. election year. You're going to see volatility in the financial markets. We've seen it. I mean, look at yesterday was a great day in the stock market. And then today was a complete reversal of big sorts because we had numbers that came out in the US that weren't very healthy for the economy, so people of course freak out. So we're seeing this this volatility, and I think that volatility will be implied for the next few months until the US elections are over with. But what you can do is use companies like LoanPad and Cufflink and Unbolted and Not Financial Advice. Of course, please do your own research, but you can use those to create some kind of a stability in an overall investing portfolio. Now, I would never tell people to put all of their eggs into any basket. Also, that comes the same with stocks and shares. I think it's good to take a percentage, cut it up. If you can get yourself into some real estate, it's not such a bad idea also, but obviously it's an expensive way to do it. But use peer-to-peer, use stocks and shares, use a savings account. If you're so inclined, use some Bitcoin, gold, whatever it is you're comfortable with. And yes, I absolutely think that short answer to that question is peer-to-peer. Yeah, it's definitely still worth investing in. Now, will problems appear in the future? Who knows? I mean, the crystal ball never knows. I don't know. Could those companies go bad, the ones that are doing well right now? Sure. It's absolutely possible. I mean, black swan events happen. Look what happened with the pandemic. It sent the lending world into some kind of a turmoil, but out of the back end of that turmoil was a big growth in the lending world when people piled back into property, piled back into stocks and shares, and we saw this huge growth uptick from after the pandemic happened, continuing through to now in 2024. So, look, there's no guarantees. Always be prepared that you can lose money. I've lost money investing in peer-to-peer lending, and I've lost money investing in shares. I lost money investing in real estate. 2008, perfect example. 2009, a lot of people got hurt financially during those downturn cycles. Nothing is immune, right? Nothing is immune. If you are afraid to invest, nothing's immune. Look at the people who had money in the banks in countries that have experienced really severe economic problems, like Iceland. At one point, there was a run on the banks. Other countries have had runs on banks where even money in the bank wasn't safe. So nothing is completely immune. Cash is not immune. Fiat currency is being eaten away by inflation. So there is no golden ticket to investing. Even money in the bank is not a golden ticket. But I think if you hedge everything, I say put a little bit into each thing. That is really the best way of protecting yourself. And I absolutely think peer-to-peer lending is worth a percentage of a portfolio of what you have to invest. What that number is for some people, it really depends. Personally, mine is about 10 to 15%. Some people I know have gone way higher than that, 75%, 80%. They've gotten hurt during times when they invested through the wrong companies and the wrong loans in peer-to-peer lending, which is why I say, it's probably not a good idea to put so much in like that, but I think 10 to 15% is a good number to hedge at. And go from there, and I always say if you haven't done it before, start off small. That's what I did with RateSetter. It was the first company that I invested through with peer-to-peer lending. I put, I think I put a couple of £100 in for the first 2 months, and I just became familiar with how the system works, and then slowly increased until I had a bigger sum of 5 figures in there, but I certainly didn't do it quickly. Every time I've done something very quickly, I've always regretted it. A couple of the companies I did things quickly in that did not work out well were Money Thing. I went fast into that. I went fast into Saving Lendy, and I went fast into, what was the other one? Collateral. And Collateral has been a complete disaster. So go small, understand what you're doing, come listen to the people that talk about peer-to-peer lending who know what they're talking about. There are a few people out there. and do your research, do your due diligence, and learn what it is that these companies do and how you can really protect yourself. That's the best advice I can give. But yeah, going back to your question, I do believe that it is still worth investing in, depending on your risk tolerance. Again, you can go lower risk with some companies and higher risk with higher percentage return offerings, which are not guaranteed with other companies. So again, you got to kind of figure out what your risk tolerance is. No different from investing in stocks and shares. Some people go 100% into NVIDIA or high octane stocks, and there's other people that choose balanced portfolios with bond funds and index trackers, which are very balanced and don't have a lot of risk volatility. Even when the markets are bad, their portfolios are not going to drop by 10% in one day. So I think the same rings true for peer-to-peer lending. I hope that answers your question on that. Let's see what else we got here. Oh, this is, by the way, I did a little, I don't know if you could see that, but this was Collateral's website on the Wayback Archive, which is kind of funny. Services for this domain have been continued. So yeah, that isn't really a good snapshot of Collateral's website. We had a Blend Network Property Pulse, which they put out the first of each month, and this is pretty interesting for looking ahead towards the real estate market in the UK, which of course directly ties into what Blend Network is doing and the loans that they offer, and whether you think Blend is a good place to put money. It says, according to Aberdeen Asset Management, which is a big one, the UK is spearheading a worldwide recovery in prime real estate assets, and the total returns from UK property will average 8% a year over the next 3 years. Again, that is just an estimate. Sometimes these asset management companies get it wrong. Plus 15% activity remains healthy, according to Rightmove's highest house price index. The number of property sales being agreed in July was 15% above the same period a year ago, when mortgage rates were approaching their peak. Maybe that has something to do with the Bank of England rate cut. People are optimistic about what's going to happen with mortgage rates and more willing to invest. And then mortgage approvals were flat. The Bank of England's money and credit data show that net mortgage approvals for house purchase remain broadly stable at 60,000 in June, roughly the same as May. The average effective interest rate, the actual interest rate paid on newly drawn mortgages saw a slight increase of 3 basis points to 4.82% in June, which we should see that rate start to fall, which bodes well for peer-to-peer lending because property developers are going to want to take out loans to build houses for people, especially now you see these positive projections in the average house price going up 8% on average, according to Aberdeen, a year, and then property sales also increasing. So you'll probably see more peer-to-peer loans going through. Now, going back to this question of is peer-to-peer lending worth it, I got a Q2 2024 portfolio update from London House Exchange, which is kind of a different peer-to-peer lending model. It's more of a share purchase to buy properties. And my personal feeling about London House Exchange has kind of been a disaster. It's one of those things that just didn't really work. It was one that I had a small investment into. For anybody that doesn't know, I used to put a lot of bits of money into different peer-to-peer lending companies to just to test them out and to be able to write about them. At one point I had, I think, over 20 investments in different platforms, some more money than others. London House Exchange was one of my smaller investments, and it just really didn't work. I went and sat down with the CEO of the company several years ago, and he gave me a very bright picture of what they were doing. But there was some things that were not sitting well with me about it. And one of the main things was taking out debt leverage, which they were taking out mortgages to finance 50% of the purchases. And I always worried that while interest rates were low, that was good. But when interest rates were projected to climb, this would really hurt the business. And that's really exactly what happened. London House Exchange got hit by higher interest rates. So all of these huge properties that they had bought were leveraged 50%. And of course, what happens, the loan servicing debt increases and people start to get very nervous about their investments, and they were selling shares in their properties, and the prices were starting to drop and fall. And then what happened next is you just didn't really see any new activity on London House Exchange. They haven't offered a new property on this platform in, I would say, several years, which is a big problem because these companies, they have to offer things to make money, right? They have to bring in new deals. They have to bring in new investors. Well, there's no new investors coming onto this platform because what's happening. So they put out a performance report, and I like to just kind of go through it because number one, I have some money tied up in there, which I've kind of just said, well, I'll leave it in there and see what happens. I don't really expect much. If I get the money back, I'm happy to get it back. If not, it's just going to be a tax loss. But this is the 10th year that the London House Exchange has been in business. Remember, it used to be called the Property Partner. So 10 years, and they talk about the challenges that they face right here. COVID, fire safety issues in the wake of the Grenfell Tower disaster, which meant that some of the buildings that Property Partner and LHE had invested into were now facing the same fire safety issues, and they had to fix these issues, and they were quite costly. That was something that London House Exchange didn't plan for. Again, another problem with the business. Some of the other challenges, the shift in demand away from town and city center flats caused by the pandemic, changes in regulations like ground rent variation, blah, blah, blah. And here you go. We have not launched new investments on the platform for some time, partly due to the uncertainty created by the aforementioned challenges, but also because we needed to focus on our current portfolio. Our actions to date have been critical to ensuring stability, and the entire team has been part of this endeavor, from creating mortgage bonds to remove the pressures of mortgage interest liabilities and to protect cash flow. So basically, they're issuing bonds to their investors saying, bail the system out, invest bonds so we can make enough money to pay the interest on these loans that we took out. Complex tasks, legal, wrangling of resolving fire issues, blah, blah, blah. Despite this, we understand and appreciate investors' frustration. So there you go. Investors are frustrated. They don't want to put any more money into this product. Why would they? It's not like they've been really doing well off it. They haven't been getting any good dividends off of their shares from rent. Everything's been negative. So why would they not be frustrated? I'd be mad if I had any substantial amount of money in this company. I'd be upset too. They remain committed to achieving the best possible outcomes and ensuring the longevity of the platform. As such, we are currently working hard to bring new opportunities to the platform, both debt investments in the form of high-yielding secured bonds and new equity opportunities. Yeah, if you are somebody after all these years who is going to invest in high-yielding secured bonds through LHE at this point, I don't know what to tell you. Certainly, it's not something I would touch with your money. We understand from investors they want a certainty of income, which is harder to produce with individual residential assets in the current market, hence because the debt they took out is too much. So the interest rate payments they're having to pay on the loan is too much, and they can't make any money because the rent yields are low. If your rent yields are 4%, you're paying 7% on a mortgage, then do the math. You're not going to make any money. We're looking at both debt opportunities in the commercial sector that can produce high yields and benefit from long-term lease structures. Mortgage bonds have proven to be highly popular with investors, says who? Due to the high level of returns. See this, look, high level of returns. What kind of risk are you taking on something like these mortgage bonds to get these high level of returns? Be very, very careful. Our platform and technology remains unique, blah, blah, blah. Our parent company, Better, is highly supportive of our endeavors. Yes, they were bought out. How long will Better continue to be supportive with them losing money for long periods of time? I don't know. So the market overview, blah, blah, blah. We don't need to go through that. But what I do like to look at are these stats of where they are with their portfolio. So they've got 204 units let. You can see this is starting to decrease as the year has gone on, simply because what's happening is a lot of people are voting to exit these investments. They have a 5-year vote, and every time I see a vote, nobody ever really wants to hang on to these properties. People want to get their money out. As investors get their money out, I would imagine a high percentage of them will never come back in. They will be running for the exits and happy if they can get their money back out, which doesn't happen all the time. They have 53 units now for sale, 76 vacant under offer, 337 units total, which is down from 442 on the 31st of March 2023. So they've reduced their units by almost 110 of the 191 sold. Rental performance has been better because rents have increased in the UK, blah, blah, blah. So they're doing okay with that. They've had 22 residential unit sales completed in Q2 of 2024, amounting to 3.9 million. And property value, sales prices were on average, look at this, 4.9% below their vacant possession value and 0.7% below their purchase price. So some of these properties were purchased 6, 7, 8 years ago, and they still haven't been able to achieve property sale prices above their purchase price when we've been through kind of this worldwide, well, no, I wouldn't say worldwide, but we've seen a big uptick in the prices of property, so that goes to show you these investments weren't that great. Of the residential units sold in this quarter, 44% were London flats, which sold on average, look at this, 13.1% below purchase price, with the remaining 56% being regional properties, which sold for 11.7% above purchase price. So London has not been good to London House Exchange. And the majority of their London properties that they've sold have just not done very well with the resale. While house prices continue to increase on average, this is primarily driven by price of growth in houses, blah, blah, blah. Let's go down to the mortgage debt. Here we go. The average interest rate across our mortgage portfolio, look at this, 8%, which is unaffordable for the majority of residential properties. Did you not think about this, London House Exchange? This is a reason why I did not invest too much through this company. Not to sit here and say I told you so, but I wrote about this very early on when I was reviewing them about this mortgage, that I thought this would be a problem. But their mortgage stands at 8% on average, which is ridiculous. The cost of servicing mortgage debt erodes rental income, blah, blah, blah. We are continuing to pay down mortgage debt wherever possible, predominantly through unit sales and also mortgage refinancing. The total mortgage loan to value reduced to 42% from 44%. So they are going in the right direction, to give some credit there. And then look at this, dividend distributions. The following property will have its dividend reduced from 2.63% to 2%, so you're lucky if you're getting anything. But the average net dividend yield on the 5 properties distributes 3.44%. Following recent unit sales in mortgage bond properties during Q2 of 2024, there has been a partial repayment of capital interest in 2 bonds. I don't know. I mean, these bonds, look at 9.25%. You're taking on serious risk. And then you can see here July-August shareholder votes. Here's one in Derby, the block listing phase of the 5th year anniversary. That's when they vote after 5 years on the building. Concluded on the 29th of July. It was not fully funded by LHX investors. Surprise, because nobody's investing in this stuff. As a result, the property will be sold and net proceeds will be returned to all shareholders. So if you do own any shares in Mulberry House, Torquay, Woodside Road in Tonbridge, get on there and vote. Whatever you decide you want to do. I vote to sell every time, just because I want to get out of this situation. I think it's not good now. Properties with fire safety issues, you still have 7 properties that are impacted, and they're going to cost probably a lot of money to fix. So not a great situation over at Property Partner. They did start out as a very promising system that they had there, but the problem always is, if you don't do it the right way, you bear the brunt of the problems that happen in the future, and that was what happened with London House Exchange. So apologies, if you have any significant amount of money in there, you might want to consider just getting rid of your shares, even if you have to take a loss at this point. Just my view on it. I don't see a lot of positivity coming from the outcome of this one. Do I think they're going to go into administration? I don't know. I don't know anything about what's going on over there, but I'm always say buyer beware and keep an eye out for what's going on over there, even though, yes, they do have investment backing from better, but it doesn't make me feel good. We have, again, had pretty crazy volatility in the stock markets. I'm going to show you about the Trading 212 portfolio and what is going on. Yeah, it's been a weird day. The S&P 500 is kind of, what are we down? 1.85% today after having a really good day yesterday. Who knows? I don't really understand now this bipolar stock market, what's going on. You try to make sense of it, but at the end of the day, it's going to do what it's going to do. Of course, when numbers come out, why are we not seeing the chart? Come on. Thank you, Yahoo, for not showing me the chart. But you can see here, minus 1.88%. Let's see if we can pull it up on Google Finance. Okay, so show me the money charts. Here we go. Yeah, it's been a rough day. Down 1.88%. Yesterday we saw a spike where we went from 5,400 up to 5,556, and then 1 month it's been down about 1%. So a lot of news coming out today in the U.S. markets about job situations. Where's my article? Weak economic data. Let me pause this video. Weak economic data. 10-year Treasury yield moved below the 4% level for the first time since February. It's not a good sign. Facebook had really good earnings results, but that didn't seem to really move the market. And it showed the U.S. manufacturing sector sank further into contraction territory during July. Jobless claims rose to an 8-month high, and construction spending unexpectedly declined. The readings reflected a cooling in the U.S. economy that reserved and revived concerns about the risk that interest rates at historic highs are driving us in the U.S. towards a recession. So the U.S., of course, did not decide to cut interest rates yesterday. And, the interest rates are really just hurting many different things. The way businesses borrow money is costing more. The real estate prices, mortgages, costing more. And people are losing their jobs. So the stock market, of course, reacts to information like this. Let's have a look at the Trading 212 portfolio. You can see we have had a really, really rough day, and a couple of changes to the portfolio as I continue to bang my head against the wall when I think I'm making some traction towards getting the portfolio up to 25,000. It just keeps on getting knocked back. You can see right now we're at 21,225 pounds. We were close to 23,400 just a few days ago, and now we've knocked back about 5 or 6%. Advanced micro devices, which I knew were going to have good earnings reports, did, and the stock absolutely went gangbusters. You can see here, right there, this was earnings after the market closed. So we went from 134 all the way up to 153, which is why I took a position. And then, of course, today we're just right back down under that point. So we are in the red on that stock. Coinbase is releasing earnings today. I think earnings are going to be good. So I expect that stock to do well. But, I mean, you can see right now, 208.70. We've been as high as 260 on this stock. So crazy volatility. Of course, Bitcoin has taken a big knockback too this week, about 10%. Creative Reality still continues to be in the green. That's another stock seeing really high volatility. We've been as high as 507 and gone back down to 457. Nvidia having a rough day, minus 13%. Some could say, hey, this is a good place to pick up some discounted shares if you believe in high octane AI, and they are leading the world in AI, and they're going to have an earnings report in August, so which I again expect to be good, and this stock price to rally. So Rivian was in the green up here, up to $18, and now we come all the way back to 14. And then Valco has been the one bright spot. Of course, the energy sector doing better now than the tech sector, so 10% up in the last month. What did I do to this portfolio? I got rid of two things. I got rid of Mobileye, the Israeli self-driving, autonomous driving company. They came out with earnings yesterday that were positive, but the stock did not do well. And the more I've researched into autonomous driving, I'm actually not convinced that we will ever see autonomous driving happen in the way that we would want to. You can see here I sold the Mobileye at $19. I put in a aftermarket hours sell when I saw the stock was not going to do well, and took a 571 pound loss on that. So hey, this is what happens when you pick stocks. This is the reality. A lot of people are only going to show you the wins. I'm going to show you the losses. This is not fun, when you are in it and you lose 500 pounds, and that was not a long period of time. And sometimes theses change. I thought maybe this would be a good long-term investment, but then I've read things about fully self-driving software and what it's going to do and what it's going to become. And I just, in the bottom of my heart, believe that it's likely not going to be something that happens anytime soon. And if it does, I just think there's too much human factor going on for any of these cars to be able to drive themselves. So I changed my thesis, and I made a mistake. Mobileye Global was not a good investment. I also got rid of GitLab here. I sold that for a 50-pound loss. Again, thesis kind of changed on it. I just didn't feel good about that investment either. So again, that was a trade that wasn't too harmful. It was a 50-pound loss. But I wanted to look for better opportunities. And today might be that better opportunity. Might be a good day to pick up some more NVIDIA stocks and get ready for that earnings report in August. So yeah, that has been the changes to the portfolio. For better or for worse, we'll continue to keep plugging away at it. Let's see what else. We've been going for about 40 minutes. So I think this really goes along with what we're saying with people losing their jobs. This is a post somebody put on Twitter about life in the USA. Salary $5,000 a month, rent $1,600, income tax $1,100, groceries, supermarket $550, petrol $250, insurance for the car $200. What I didn't agree with down here, they wrote eating out, shopping $350 and $475, money left $25, How do people afford to live? Well, I think you cut out this, right? The eating out and the shopping is kind of unnecessary. That gives you about, what, $850. But everything has just gotten really, really expensive, and the cost of living has gone up a lot. So this is why these economic data points don't look very good. I'm just going to run through some other bits of news that I found that I think it's interesting. Trump, for better or for worse, whether you love him or you hate him, is apparently very pro-Bitcoin. Now, I assume it's just for vote reasons. I don't know that he really cares about cryptocurrency and Bitcoin. But there was an interesting article in the Financial Times about Trump and the politics of Bitcoin. And it says, it is a safe bet that Donald Trump's recent conversion to Bitcoin is motivated by the big donations that come with it, which puts his Democrat opponent, Kamala Harris, in a bind. Harris would like to protect retail investors from an asset class that often resembles a Ponzi scheme. But America has an army of crypto investors, roughly 40 million. This just goes to show you that sometimes journalists write dribble. Is it drivel or dribble? For him to write, it resembles a Ponzi scheme. If we look at the technical definition of a Ponzi scheme, it's a form of fraud that lures investors and pays profits to early investors with funds from more recent investors. A Ponzi scheme can maintain the illusion of a sustainable business as long as investors continue to contribute new funds, as long as most of the investors do not demand full repayment or lose faith in the non-existent assets they are purported to earn. Well, first of all, if every single person sold Bitcoin, they would be able to get their money back out, not necessarily at the price it is today, but the Ponzi scheme does not allow people to do that because the money is simply not there. Also, Bitcoin is not a business. So using words like Ponzi scheme in the Financial Times, I think, is really a discredit and a disservice to describing exactly what Bitcoin does. Trump has said, let me say it again, on day one, I will fire Gary Gensler, who is the head of the SEC. He does not like him. But this article says this: were Trump to be elected, deregulated Bitcoin would get a rocket boost. His pledge to import the roughly $15 billion in government confiscated Bitcoin onto the Fed's balance sheet. So he's talking about taking the confiscated Bitcoin and moving it to the Federal Reserve's balance sheet as a store of value. If that happens, it's obviously going to be a very positive thing for the cryptocurrency world. Whether it happens or not, who knows? We shall see. Another letter from the mailbag. This is a good one. Lawrence, I'm 35. I want to retire. I live in the UK. I know this idea goes against what people tell me. They tell me I should work until I'm in my 60s and save. I think he meant save. But to be honest, I hate working. I don't care if I retire and have nothing to do all day. Honestly, I hate my job, but I've saved diligently and managed to amass about £1 million in investments and savings and have a paid-for house. Can I pull off an early retirement? Is it even feasible? Thanks for your input and keep up the good work. Tristan in Cambridge, where it's raining. Yeah, Tristan, good question. First of all, I don't buy into this whole thing, about work till you're 60. You may not even make it till you're 60, let's be honest. I hope you do, but there's no guarantee, right? If you hate your job, you don't like working, and you think you have the means to retire, I say go for it. 35 is young, though, and the problem you're going to have is with inflation, things getting more expensive. Can you survive on £1 million for what may be 50 more years of your life? If you're 35, let's say you live to 85, you got to get through 50 years of living. I do think it's possible. Yeah, absolutely. I don't know if anybody in the chat has been able to retire at a young age in their 30s. I seem to think most people tend to be doing it in their 50s, 60s, which is kind of the standard norm. But, I mean, you could do the basic math, Tristan. Use a compounding interest calculator. If you have £1 million to your name and you can get 5% yearly for, let's say you do it for 30 years, so you're 85, you would have, let's see, projected future investment of 4.4 million. Now, the problem that you have is spending. How much of this are you going to draw down? If you take a 5% drawdown rate, meaning you spend £50,000 a year to cover your expenses, and take that out of your million, you need your £1 million to return you 5% to basically break even, which I think is possible. It depends on how much risk you're willing to take, but interest rates will not continue to be able to afford you in a bank to give you 5% per year. But if you can have a mixed range of investments that will give you a average of about 5%, then you should be able to cover that £50,000 a year that you're going to need to live on. The problem for you is inflation is going to mean that expenses are going to get more for you as time goes on. You may need more than 50,000 to live on. I don't know what your living expenses are, but some people are able to live pretty frugally on £30,000 a year, which if you are and you have a paid off house, you may be able to do that. Then I certainly think that it is possible for you to be able to retire on £1 million at 35 years old. It's not going to give you an affluent lifestyle. I don't think you're going to be able to go on expensive holidays. But if you live carefully, I think you could do it. I think what a better idea is to try to bring in some form of income over that 35 or 50 years. You're 35 years old. Maybe you could do something you do like enjoying on the side part-time. Just bring in a little bit of cash every year to keep that £1 million at £1 million. Then yeah, I absolutely think you could retire. There's interesting calculators out there too, Tristan. For example, the Fire Calc is one that I think is cool. It kind of shows you if you spend $30,000 a year and you had a portfolio of $1 million and you need it for 50 years. This kind of gives you some geographical scenarios of what happens in different stock market scenarios if you've got the $1 million in the stock market. And it also gives you some statistics about how your portfolio would have fared in each of the 104 cycles. The lowest and highest portfolio balance at the end of your retirement was 425,000 in worst case scenario to 21 million if you have an amazing stock market run, with an average end of 5.9 million. So if you're able to keep the $1 million invested over 50 years or 30 years, 50 years, you're going to probably do pretty well. Again, do you have a stomach for that kind of risk? I don't know. So go play around with the Fire Calc. It's firecalc.com, and I think you have a pretty good chance of doing it. Let's do one more piece of feedback that we got from an email that came in July 27th from Mike. I won't give his last name. I always listen to your fascinating podcast on Catch Up. I'm never seen to be on Thursday evenings. Thank you, Mike, for checking it out. A couple of points I thought you may be interested in. This is concerning inheritance tax, which we talked about last week. Another way of avoiding this is by gifts out of income, which can be a great way of passing on to kids and grandkids. Yeah, I don't know what the limits are to doing that. And I think, again, if you can keep it 7 years out, you're all good. Secondly, concerning IES, which we talked about, those are the enterprise investment shares for startup companies, which you can, if you keep them for 2 years, they are inheritance tax free. Mike says, I have one of these. It lost 60% of its value. I decided to sell out at the end of last year, only to discover that one can't. There's no market, and the only way one can get one's money out is if one of the companies held is sold. I contacted my provider, and they said this probably would take years. So keep up the good work. Regards, Mike. So yeah, just another highlight of the risk that comes along with investing in IES shares in startup companies to avoid inheritance tax. There you go. There's no liquidity often in those shares because likely they're usually not making any money. People just don't want to invest in them. That's why the government offers tax incentives for people to put money into them because people generally don't want to. So there has to be some reason. Sometimes the inheritance tax reason is just not enough to get people in. But that, I mean, that's a really good example of why you should be very careful investing in things like that. Thanks, Mike, for sending in that email. Let's see if we got anything else. Oh, this is a good one. The S&P 500 averages over 10% annually. Long term, a 10% return on 1,000 is 100. 10% return on 10,000 is 1,000. A 10% return on 100 grand is 10K. And a 10% return on $1 million is 100,000 pounds or $100,000. Focus on building a large investment in the S&P 500 and you will become a millionaire 100%. I think that's great advice, especially, again, for the retirement question. Just keep putting money away. If you can't add to it, build up your pot. I think you're going to be in good standing. Well, believe it or not, today, right now, it is 8:22 p.m. in the UK. We actually finished up within 1 hour. So, glory today. Glory, we did it. See if you have any interesting comments. Have you seen the emails from Funding Secure about 6 hours ago? There have been recoveries on some loans that total 1.7 million, but after the legal fees, only 200,000 available to lenders. No, I did not see that email, but I'll cover it next week. Yeah, pretty much par for this course, right? The legal fees and the administrators taking most of the recoveries. And from that, administrators are going to take a big chunk. Lenders will only get 140K, just over 8% of the recovered money. Yeah, welcome to the norm of administrations. Mike Powell says, not the administrators, it's the specialist litigators that pursued the claim. 140K is how much has been paid to Funding Secure. Not clear if there will be further costs from that. Probably will be. Evening, Dave Allard. Nice to meet you. I said nice to meet you. Nice to see you. Mike Powell talking about the mortgage bonds at LHX. The bonds are actually reasonably low risk, sub 50% loan to value, 8% plus rate. Yes. Are they low risk though when you're dealing with a company that, how do you know how solid they are? Don't know about that. If you're dealing with a very solid company, I think you could make a case for doing things like that. But when you're dealing with a company that has not created any new business in years, I think you have a major problem there. Ponzi scheme sounds quite apt to me, actually. Dave Dawson will have to agree to disagree on that. I don't think Bitcoin is a Ponzi scheme. Yeah, I think people saying you can retire on $1 million. I don't know his pension situation. Do you need to invest £1 million for 50 years? If you combine investments and take a lump sum every year, better than leaving your $1 million when you die. Yeah, that's another good point, man. Why do you want to hang on to the $1 million anyways? Maybe if you have kids, you want to help them out. Each to his own. I say most people would be good just to spend everything before they die. But that's just me. No limit on gifts out of income as long as it does not affect the donor's standard of living. But you need to keep good records. Do you need to... does that still go by the 7-year rule? Lendy distribution this week. What's that going to look like, Mike? Is it going to be a good distribution? I don't know. I haven't looked into it. Usually I get just majorly disappointed by everything that happens with Lendy distributions, but that's just me. Mortgage bonds, you're not lending to the company but to the SPV that owns the property. I understand that, but the problem is that I understand what you're saying. The problem is if the company, let's say LHE or LHX, doesn't survive, you may have a mortgage bond secured, but we've seen secured investments with companies that go under and don't continue to operate, and how much of that investment is taken by administrators and fees and legal fees. That's what I'd be concerned at. No inheritance for Holly. No, she will inherit probably just a bunch of love and as many dog bones as she wants while I'm alive. See, any news on the Able rate wind down? You know what we know, Dennis. If you are an Able rate investor, you would have gotten emails on that. I have not heard anything new on the Able rate wind down. I think it's going to take a long time, just like all the other ones. So, yeah. Anyway, that's going to do it. We've 3 minutes short of an hour. Thank you for joining. We'll be back next Thursday, all being well. Thank you for spending your evening with us. Don't forget, this month we have Narinda from Cufflink Live and Peter Reed from Assets Capital. I can't remember off the top of my head what the dates are, but maybe let me pull up the calendar. So yeah, we got Cufflink on the 15th of August and Peter Reed on the 29th of August. So a couple of weeks time, brand new guest. And Peter Reed on the 29th. So, no, not brand new. I mean, Narinda's been here before. But it's always good to get a update from him. We can ask him about the loans that are in trouble. Anyway, have a great night. Enjoy. Don't drink too much. Yeah, that's about it. That's all I got. I'll see you next time. Okay, take care. Bye.